On the surface, the stock market and the bond market, and I'm talking about the US here, but it broadly applies to much of the world. The stock market and the bond market seem to be telling you two different stories. It's very hard to reconcile when you see a fairly flat yield curve at very low levels and yields that sort of decline by the day. The normal interpretation of that would be markets don't see a lot of economic activity on the horizon. They're possibly predicting rate cut, and they're certainly not predicting a lot of inflation. That's at least the superficial story that the bond market appears to be telling. Yet the stock market seems to be telling the opposite story. Broad market indices are trading at or near highs on almost a daily basis. You're getting a lot of days where the market sort of gently climbs higher, only to accelerate at the end of the day. So money's clearly flowing into both markets, but seemingly for opposite reasons. How do you reconcile the fact that one is telling you a story of a weakening or certainly uninspiring economy, and the other one's telling you the story of a rip-roaring economy that will lead to higher multiples and higher earnings? Well, there's one thing that ties the two of them together, and that is money. Um, when you have a central bank putting money into the markets, or at least the markets perceiving that the central bank is doing so, and I'll ask you to read some of the other posts that I've written on this topic and some of the other videos that I've done on this topic. If if money is flowing in, money just flows. And so if that means we're going to raise the prices on bonds, so be it, regardless of what the message is. If that money flows into equities, it's going to tell you a positive economic story, regardless of whether that's justified or not. A lot of what you see in terms of the stock market performance has been multiple expansion, which is when you take the PE ratio, and if P goes up faster than E, causing a higher price earnings ratio, that's called multiple expansion, and that's just the sign of people willing to risk more money in equities. Um, and I think partially the character of the market that you're seeing, the fact that in many ways the bigger stocks are really leading the market, which is telling you that a lot of money is basically just flowing into big cap ETFs and mutual funds. Again, money really is the key here, and so cash, because there's so few places to put it, is chasing yield in the bond market, and it's chasing equity returns in the stock market. Um, that's a very good thing, and it's very, very tough to fight. Of course, what you want to remain vigilant about then is, does that flow of money change? We're seeing the Fed balance sheet sort of top out, but we're seeing incredibly accommodative stance from the People's Bank of China. Um, that money is sort of walled off from the rest of the world, but it still sneaks out. Um, and and what you're going to see here is, as long as the markets perceive that there is a flow of money coming out of the world central banks, stock and bonds will tell you a different story. It's also what allows you to get the kind of story that we're seeing in terms of the market's reaction to the coronavirus. Well, it's really bad by any stretch of the imagination. It's bad to have 50 million people quarantined, to have a virus that people don't understand, and to take a large portion of the most populous country on earth, take them out of the equation. But when you have money flowing in, you can turn bad news into good news. Well, the bad news is such that the central banks will continue to be accommodating, so therefore we should continue to be invested. It's a bit circular logic. It works really well for a while. The problem is, at some point the game ends, and so what you have to be cognizant of, and I'm not seeing the end of it right now, although I am seeing the Fed's balance sheet sort of trading a bit sideways, at least as far as we can tell right now. But what you're seeing here is the people are investing because the money is there, and they're investing on the thought that the money keeps flowing in. Um, it's the kind of thing that you don't want to fight that trend. Don't fight the Fed is a very good piece of market advice. But remember also, you don't always have to play along. And if you get the sense that the central banks are taking their foot off the accelerator, that's maybe when you want to be getting a bit defensive. So be cognizant of that, be aware of that, be on the outlook for that. I don't see it right now. I see them maybe taking their foot off the accelerator, but certainly not hitting the brake. Um, But if you start to see any of the world central banks tap on the brakes, that's something to be very cautious about.